Hey everybody, this is Derek, and what you're looking at is a heck of a lot of debt, or you're at least seeing a big picture of the word debt, because I think it's pretty inevitable that there are a lot of people, a lot of businesses that are going through hefty debt right now. Everyone seems to be in debt up to their eyeballs, and I don't know, maybe this little picture in here is the eyeballs of the debt that we have as the financial institutions are just chomping away at it, and I guess maybe this might be their teeth as they chop away. Nonetheless, let's first take a look at how debt is defined in the dictionary, and then we can make some more sense of the issue, as it's an amount owed to a person or organization for funds borrowed. Debt can be represented by a loan note, bond, mortgage, or other form of stating repayment terms and applicable interest requirements. These different forms all imply intent to pay back an amount owed by a specific date, which is set forth in the repayment terms. I find it very interesting how they say if applicable interest requirements. Let's see, the only times I can ever remember seeing how interest was not required was, well, within a student loan here. While you're in school, you don't pay interest, but after you graduate, the interest will then come into play. And sometimes you can see specials on the television or through any type of advertisement where if you buy a car or if you go to the store and buy whatever, you get no interest for 6 months or 12 months or something like that. I guess that would help out a little bit. In one of my previous videos, I was mentioning how I was expecting that the consumer debt to GDP is pretty much getting close to even. What that means is, if you have $100,000 worth of debt and you have $500,000 worth of assets, then your debt to GDP is about 20%, as that would be 100,000 divided by 500,000. If you have $500,000 in debt and you have $500,000 in assets, well, it's at 100%. Your debt would be worth the same as your assets, and when your debt is higher than your assets, well, then you're pretty much in a bankruptcy state. I managed to find a web page that had some data going back to 1952 on the consumer debt to GDP. It was a little bit of a pain in the butt to put these numbers within the spreadsheet, but it wasn't all that difficult, a little time consuming. And I'm not too sure the validity of these numbers, but it seems as if they are pretty accurate nonetheless. And in 1952, the consumer debt to GDP was roughly almost a quarter, or 25%. And it kept going higher, 30 some odd percent in 58. We broke the 40 mark in 61. We stuck around the 40 mark for quite some time. In fact, we never got to the 50 mark until 1985. That's about a quarter of a century, and it didn't take long to get to 60, about a half a decade. And to get to 70 took up to 2001, 80 it took a couple years. And to get to 90, 2005, and the recent numbers for the third quarter of 2009 shows we are roughly at close to that 100% mark. And the graph for the GDP for consumer debt looks something like this. It seems as if the way the patterns for the chart is showing us, it has a breakout to the upside, it stabilizes through time, breakout to the upside, stabilization through time. As we had this big breakout in here, it stabilized for quite some time, then we had that massive breakout, and the interesting thing is the stabilization in here actually had a bias move to the upside, and a monstrous move to the upside. Maybe now we are stabilizing through time, as we can see that just over the last few months, it is showing us as signs that of indecision, I guess. So maybe we might be able to test the former area of resistance that can often be acted as support in stocks. After all, we went up to this level here in 96, we retraced back, and well, we made a higher high, and right now this low is a higher low than this. But nonetheless, the previous level of resistance is roughly in the 60 something. Maybe we can come back to that But I don't really think so. When we take a look at this chart with a 20-year moving average, the orange line is a 20-year average. It keeps on going higher and higher, and it's because of the debt and the interest paid. And I bring up this little simulation. Let's assume someone is buying a house at $200,000, and I've been hearing things about home mortgage rates for only 5% interest. And let's assume that the bank borrows $200,000 from the Fed, and their interest rate's a heck of a lot lower, of course. So I'm hearing that they get a quarter of a point, which would be 0.25%, but in this case, we'll do a 0.5%. And in the first payment you would have at a $200,000 loan at 5% interest for a month, it would be $833 interest, where at a 0.5% it would be $83 interest. So what I have used for a formula is I take this number, which is the principal of $200,000, I multiply it by this percentage divided by 12, that gives me $833, and then this number is this number, subtract the 1,800, adding the interest, which would bring us $199,033, which is the principal. And if we scroll down, we can notice that the bank would be finished paying their loan after 114 payments, and you would be finished paying after 150 payments. You would have $69,000 worth of interest within the loan, and the bank would have $4,820, and this would be their profit of $64,309. The reason why is because within the first month they gave you the $200,000 loan that they received from the Fed, and then of course this would go to the home buyer. Nonetheless, when they pay you $1,800, well, they're going to take that $1,800 and pay the Federal Reserve with it. You got nailed with $833 interest, they got nailed with $83 interest, and thus they would profit $750 on this, and the Federal Reserve would profit $83. Well, you are left paying for their profits. And obviously, if it was like, say, 2%, then they would still be making a nice little profit on you. But even at 0.5%, or how about the 0.25%, the profits would just be extremely high. They would have the bill paid off in the 113th month. And basically what this is showing us is these debt numbers just continuously add up. This is one case for one house at $200,000 at 5%. Now you take the rest of the population into play. You take credit cards, student loans, anything you can think of, and even look back at the times when we had higher interest rates. Folks, this is one of the reasons why debt is guaranteed. So I'd like to thank you for watching this video. If you have any questions or comments, please ask them within this video, and take care, everyone. Bye-bye.